On Wednesday, the United States Treasury doubled the size of its bond buyback to $4 billion a session, and by Thursday, the rate it was trying to move had gone right back up. The move was meant to calm a bond market that had been selling off for weeks. Instead, the calming effect lasted less than one trading day. It is a strange kind of failure, putting real capacity to work and getting one day of relief. A Treasury bond is a loan to the government. When investors want to hold more of that debt, its price rises and its yield, the return a buyer earns, falls. When investors want to hold less of it, the opposite happens. Prices fall and yields rise. For most of this year, yields on the longest dated government debt have been climbing. The 30-year yield touched its highest level since 2007 earlier in the week, and total outstanding government debt passed $40 trillion for the first time. Traders had been demanding a bigger premium to hold that debt, worried about the size of future borrowing rather than any single event. That premium does not stay contained to government bonds. The 10-year yield, in particular, sets the tone for mortgage rates, car loans, and credit card borrowing costs across the economy, which is why a move in a number most people never look at still reaches every household with a loan. Here is what actually happened. The Treasury did not create new money or pay down the debt. It used an existing legal authority to buy back older bonds directly from investors, using cash it already holds, and said it would double the size of each of these operations from $2 billion to $4 billion, starting in September and running through the first week of November. On the day of the announcement, the 30-year yield fell from about 5.26% to as low as 5.18%, and the 10-year yield dropped from around 4.68% to 4.63%. Stocks rose. The dollar fell by the most in 3 weeks. One investment strategist described the move plainly. It is not a debt paydown, it is a rearrangement of the maturity schedule of the debt that already exists. By Thursday, the reaction had faded. The Dow fell about 700 points. The 30-year yield rose 2 basis points to 5.222%, and the 10-year ticked up to 4.67%. The reason is straightforward. A single buyback operation changes how much debt trades hands on one day. It does not change how much debt the government still needs to sell in total, and it does not change the underlying reason buyers had been reluctant, a section of the bond market that had seen weak demand since late June. United States government debt is the benchmark against which credit is priced worldwide, held by pension funds, foreign central banks, and insurers on every continent, which is why a shift of a few basis points here moves borrowing costs for governments and companies far outside America's own borders. One day of buying can move a price. It cannot resolve a mismatch between how much debt is being issued and how much investors currently want to hold. None of this is unique to bonds. Almost every market reaction plays out this same way, in miniature and on a much faster clock. A headline moves a price within minutes, and a day later, the price often gives most of it back once the underlying facts reassert themselves. What separates a calm response from an emotional one is rarely intelligence. It is timing, whether a person is reacting to the first sharp move or waiting to see whether it holds. Most people can describe how the market felt on the day a headline hit. Very few can describe what actually changed a week later, because by then the emotion has faded along with the memory. Watching what happened this week, to a rate almost nobody watches, is a useful reminder that the loudest hour of a story is rarely its most accurate one. It is exactly what Whisper was built to show you. Whisper.live